In the long run, what ultimately determines what a stock is worth is the company's business, the fundamentals, the operations. That really determines whether your stock and company go on a 20-year run, something like Apple that keeps surprising with new highs in stock price, or a 20-week run or a 20-day run where the stock kind of runs out of steam, falls back down to earth. I want to present kind of like a no-nonsense investor's point of view of what the key metrics are you want to look at, why they're important, what context to use them in, and kind of get past that boring textbook stuff you'll usually see about all the different ratios and all the rest. There's really kind of four areas we're going to look at, and they're all important in different ways. The first is profitability, obviously the most important thing to investors. Up next is the operations and financial performance to get a sense of how the company is operating. We're going to look at capital efficiency. Is management really kind of using all of its resources to its best? And the health, the financial health of the company. Are there any kind of debt problems and all the rest? So getting into it, let's start with the most important metric, which is earnings per share. Now, an interesting thing about a lot of these metrics is something like earnings per share sounds like it's kind of written in stone, something easy to get to. There's actually a lot of assumptions that go into there. So there's two flavors of earnings per share. And this is why sometimes stocks will report and it looks like a beat, but then the stock is down, or it looks like a miss and the stock is up. There's a whole lot that kind of goes into this. But earnings per share at its basic element is net income minus preferred shares divided by the number of shares outstanding. So what did the company make? You pay off the preferred shareholders who rank above regular common equity holders, and whatever you have left over is divided between all of the shares that are outstanding. You have to go past that net income figure, because if the company keeps issuing shares, you only get what is coming to your share. Now, like I mentioned before, in accounting, there's something called GAAP, G-A-A-P, generally accepted accounting principles. All companies have to report according to GAAP. Now, this is important because when you're providing something like a net income, there's a lot of assumptions that go into there. So when do you recognize revenue? Is it coming in this quarter, next quarter? Same with expenses. How about loan loss provisions? If you sold a lot of products and you say, probably about 10% of these are going to come back to us in returns, you have to keep kind of provisions for all this, for warranties, all these kind of things. So how aggressive or conservative you are on some of these metrics will really weigh and change your net income. So, GAAP, which is set up to kind of standardize that to its best. And so the diluted earnings per share is pretty much the key metric most people are going to want to look at to start with. Fundamental investors will almost always choose this version of earnings per share, this flavor, because it kind of will provide that margin of safety. It looks at everything from the most kind of straightforward method possible. However, for a lot of kind of younger, more dynamic, faster growing companies, sometimes there's a lot of these one-off expenses that don't really reflect on what the business is doing. So a lot of companies choose to also report adjusted or non-GAAP earnings. They always have to report the GAAP earnings, but they can choose to also report these non-GAAP earnings, and they always have to explain in their filings how they got to this different number. Now, why would you do that? Let's say you're a young company and your operations are doing great, you're growing strongly, but you're providing some really massive incentive pay to some like rock star programmers or some really important people to the business, where you say, look, ultimately, this won't impact our ultimate profitability. It's a one-time thing to get this person on board, this big signing bonuses or something. So the business itself is actually doing very well even this quarter, but we show a loss because of this one-time onboarding fee. And so the management says this non-GAAP earnings per share removes these kind of anomalous numbers that are not part of the real core business. We want to show you what the actual business is doing when you take out these, one-time expenses, let's say. So that's kind of the non-GAAP versus the GAAP earnings per share. So when you kind of put all these factors together, what sounds like an easy number, earnings per share, there's really all these kind of different elements to it. We're going to look at some examples here coming up. First, let's take a look at Microsoft. So you can see the chart here below. We have this nice data table. It's something I put out recently on TradingView. It's a CF360 indicator, Caruso Financials 360. There's a link below if you want to learn more about it. So you can see here in the top, there's the quarterly earnings per share. And you also, on the bottom, you have the annual earnings per share. Interestingly, you can see the green background within the earnings per share figure. That means it's a record number. So, why is Microsoft at all-time highs, and when you zoom out, it's just a beautiful climb? Well, take a look at earnings per share, especially on an annual basis here in the bottom area. it's growth year after year after year. You can see the top line is the earnings per share. Right below it, you can see what the growth rate is compared to the year before. So it's really kind of no wonder what drives the company. It's obviously these earnings per share, but of course, the difficult part is trying to estimate what it's going to be next year. Does that growth continue? If you can get that right, you probably have a good idea of whether the stock will continue to be a winner or not. Now, let's take a look at another stock, GTLB, GitLab. This is a younger company. It's not as established as Microsoft, and you'll see that whether you switch between GAAP and non-GAAP, you can see a very dramatic difference. So first off, if we take a look at the adjusted non-GAAP data, it doesn't look very impressive. So you can see sales are pretty consistent here. You can see them quarter by quarter, very strong sales. If you're looking at the quarter over quarter earnings growth, they look like the company's losing money. They're not really growing from the year before, so not all that impressive. But if you switch over here, if we go into the options and you select the non-GAAP data, it's a cool thing here. You can select from the different types of earnings that you'd like. If you select non-GAAP, take a look at that. What a difference. You can see kind of record numbers and definitely growth. Although there's still losses, the losses are narrowing and they're pushing towards profitability. Not only is it a very different picture, but also you can see the trend is much more consistent. It looks much more like a business that is driving towards an ultimate outcome versus the regular GAAP data. If you look at this looks like, kind of random. One quarter is a good quarter, bad quarter. You don't see the actual focus on how management's trying to drive this company. Now, which is better? Like I said, the value people will tend to prefer diluted earnings. It's kind of the one that will factor in, I don't want to say the harshest, but probably the most realistic really view of what's going on, and they want that margin of safety. Someone who's a little more of a growth investor is less concerned about the current quarter, is more concerned about the trajectory of what this company can ultimately turn into. And in that respect, sometimes pulling out those one-off expenses and looking more at the core of what the business is doing makes a big difference. Next up, let's take a look at margins. So here we have gross margins, EBITDA margins, and net margins. So all margins, but they all really kind of give a different flavor of what's going on within the company. Now, this really kind of gives a good idea of the performance and the operations. And this is really best used, in my opinion, comparing one company in one industry to another company in the same industry. So you can see how is management able to kind of source their products, sell their products, and drive profitability. So the gross margin really shows just that. It's just what are revenues minus the cost of the product. And that kind of gives you a good sense of, are these two companies in the same industry able to operate at a similar cost structure? If your company, it's much more expensive for them to source their product and you have smaller gross margins, that's a bit of a warning flag. It's going to be hard to be as competitive if your gross margins are much smaller than your competitors. Moving on to EBITDA, that's earnings before depreciation, amortization, interest, and taxes. So basically, again, trying to look at just the heart of the business, ignoring financing costs, ignoring taxes. Not that they're not important, we'll get to that next with the net margin, but trying to look at just the core operations and ignoring everything else, kind of staying in a vacuum. Let's assume that having to borrow money is not an issue or anything like that. Looking at EBITDA margins, again, this now comparing two companies in a similar industry. Once they've paid their product and now they run the operations, how profitable are they at the operational perspective? Does someone need 5,000 employees, the other person's running only with 1,000 employees? That's going to kind of start to come up inside EBITDA, and you're going to notice a really big difference between how efficient companies are running their operations. Last up, we get to net margins. Now this kind of basically, no more assumptions, no more looking at just small details. We're looking at the bottom figure. Where do you get to profitability? Hopefully you get to profitability. And how profitable is one company compared to another? So let's take a look at a good example of this. We'll look at the cybersecurity space. And these two companies are not exactly comparable, but we'll look at Palo Alto, P-A-N-W, and Tenable Holdings, T-E-N-B. If you take a look at Palo Alto, this is probably, first of all, taking a look at the stock chart, what an incredible run. We can look at the same earnings per share we discussed before, powerful growth, and taking a look at their gross margins, EBITDA margin, and net margin. This is a very well-run company. But how well-run is it? Well, the best way to kind of compare is let's take a look at TENB, which again is in the similar group. How are they doing? Well, first off, the stock chart is not nearly as powerful as Palo Alto's. And when you look at the gross margin, of Tenable, you have a weaker figure than Palo Alto, same for EBITDA, same for net margin. So clearly, in terms of the gross margins, cost efficiency, EBITDA for operation efficiency, and the net income, just general efficiency, Palo Alto is a better run business with better profitability and earnings per share, and that then gets reflected in the stock price. And that's what we're getting back to. How do we select between companies? Even if we want to be focused inside a certain industry, who do we pick? And this is a great example of applying these different metrics to get to that end. Now, next up is, once we're done worrying about profitability or operations, how efficient is management with the resources they have? This is important. This really points to, do you have a good leader or do you have poor leaders? There's an old saying by Alexander the Great where he says, I don't fear an army of lions led by sheep, but I do fear an army of sheep led by a lion. So the person in charge who's the driving force, and there's a lot to that. There's the Steve Jobs of the world, Reed Hastings, so many great CEOs that can really drive these incredible visions into these companies. We want to know how efficient is management with capital, with shareholders' equity. So return on equity gets right to the heart of that figure. Now, William O'Neill, in his book, How to Make Money in Stocks, this is one of the key fundamentals he looks at. He found that the best stocks historically have at least a 17% return on equity. Why does this provide a good view of efficiency? Well, a company has only so much, equity to work with. And if they have a lot of cash and that cash is not being deployed, it's just sitting idly inside a checking account, well, they're going to have lower returns on their general equity if they're not deploying all of their cash properly. Or if they take out massive debt, a lot of loans, they have huge interest payments to make, but what they invested that debt into is not providing a big enough return. It's providing some return, but not a big enough return to really offset all of the interest charges and all the rest. They're going to have a low return on equity. So how is the company doing? How is the management doing with the financial power in their hands? Are they efficient with it or are they wasteful? That's what this indicator gets to, this metric. We can look at a couple of companies here for an example. Again, you can take a look at Palo Alto and we can compare that to TENB, and you can see the differences between different companies. The last two metrics I want to look at is, you can be as profitable as you want, but if you have financial health problems, eventually this is going to kind of catch up to you if you have too much debt or you don't have enough cash coming in and out. It's even as a person, sometimes people will call themselves asset rich, but cash poor. You have, let's say, a lot of real estate, but you don't have a lot of cash in the bank for your day-to-day expenditures. That's where free cash flow per share comes in. Gives you a good glimpse of the liquidity within the company and how they're able to manage their resources. Are they going to get into a liquidity crunch where then they have to go borrow money, maybe at a bad time in the economy or something like that? So free cash flow per share really looks at what is the cash flow from operations after you account for the expenditures that go out. So really getting to what the free cash is available for the company and dividing that amongst all the shares outstanding, getting a glimpse per share to get a sense of what cash flow is like. Again, very helpful. This also gives a good glimpse into what earnings will ultimately be. I mean, you can generate all the cash you want if you have a ton of expenditures. There can be a lot of assumptions for future growth, but eventually that cash has to kind of come back to you. So this is a good metric to always pay attention to. In that vein, not only do you need that kind of cash flow to work your business, the amount of debt you're taking on is also important. But debt is I think a really important, is a relative measure to pay attention to. You want to look at debt versus your equity. A little bit of debt is not a problem if you have a lot of equity. So the debt to equity measure does just that. And you can see here also in the dashboard, we have all the different kind of free cash flow and debt to equity measures. This really helps you to kind of also compare two stocks within a similar industry group. Again, is one stock driving earnings but has very little debt to equity? Is another one driving the same earnings but has taken on a lot of debt and is very levered? That's why you really want to pay attention to the debt to equity numbers as well as free cash flow to give you a good sense of what the health is of the company, the financial health, looking beyond everything else, really just, can they sustain what's going on given their debt levels and cash flow. So I hope you enjoyed this video. I hope it gives you a good understanding. If you enjoyed this dashboard, please take a look at the link below. You can add this indicator to your TradingView charts. There's a whole bunch more information there, and there's over 88 metrics inside this one dashboard. So there's a ton of information we didn't even touch on. Again, kind of looking past the numbers, understanding why they're important. That logic test is always vital. And this hopefully gives you a good glimpse of to kind of understand How is your company doing in terms of profitability? How is it doing in terms of efficiency, capital efficiency, health in terms of debt levels? How do you compare this versus other industry peers? All really healthy metrics. When this lines up, when this shows a healthy company and you tie that together with a strong chart showing institutions are buying the stock, that's really where the magic comes, because you have not only a strong stock chart showing accumulation, but the fundamentals to support a more extended run. If you enjoyed the video, you can follow me at trader_mcaruso. Also visit my website, carusoinsights.com, link below. Talk to you soon. Thanks so much.